A lot of times individuals tend to underestimate what they need because now, especially now, with the advancement of medical technology and services, you have a big increase in the number of years you're expected to live after you retire. Sometimes it goes up to as much as 30 years. Now, let's talk about what you need to do at various stages of your life and the advantages of starting early. Joining me to talk about this is Prableen Bajpai, the founder of FinFix. Thank you so much, Prableen, as always, for taking the time. Good evening to you.
Good evening, Alex, and to all your viewers.
Now, a lot of the young viewers that are tuning in will have experienced this over the course of their financial lives so far. They're earning a paycheck. They want to buy the latest gizmo, the latest gadget. They want to spend on things that they really want to enjoy. They don't really want to cut back on that and invest because retirement is so far away. Can you potentially balance investing and still enjoy life? That's the question I think that is most important. And what, according to you, are the benefits of starting early?
Absolutely, Alex. First thing, I think that, this age doesn't come back. So for any youngster out there, yes, it's very important to go out and have that Starbucks coffee, enjoy your Saturday evenings. But I think the path of moderation is one which can work best because there you're balancing your present as well as sort of not ignoring your future. And I think we've got enough data to sort of prove that if you're starting with your investment journey early on can help. And actually, if you do a survey, checking with people in their 50s and 60s today, that probably even 40s, what is their biggest regret when it comes to investments? I think majority would say that we didn't start early. So I think with some data, I'd like to illustrate how investing early can actually help. So the first illustration, Alex, I want to give an example how we have three investors, investor A, B, and C. And let's say one starts investing at the age of 25, one starts investing at the age of 35, just 10 years later, and the third one starts investing at the age of 45. And if all of them start investing 10,000 rupee a month, and we assume the same return for them at 11%, this is the return I've taken for equities, so a conservative 11%, and they all build a corpus till about 60 years of age, how much would they accumulate? So the difference between what investor A, who starts at 25, can accumulate is actually 10 times how much the investor C can accumulate. So investor A is able to generate about 4.97 crores in this time period. And investor B, just 10 years late than investor A, her corpus would be about 1.59, almost 1.6 crores. And investor C would only be around 46 lakhs. So it's a very, very huge difference that the time which goes into investing can create. That's the first illustration, Alex. Then I think, I like to highlight a point that often when we discuss with youngsters that when you want to retire because there's no more synonymous to, being old and fragile. It's more synonymous to being financially free. So a lot of people say that we want to retire by 45. So somebody who starts off early can actually benefit because even if he or she is investing from the age of 25 and keeps investing for 20 years and then stops investing the same 10,000 rupees and just leaves that money aside, still that person will be able to accumulate about 4.17 crores by the time he or she is 60. And this is because, Alex, the compounding of the initial investments would actually work so well in this overall time period. So the allocations are only for 20 years, but the overall corpus is still 4.17 crores. So I think that's the second point. And the third, I think the biggest advantage here is that when you start investing early, the monthly ask or the investment that you need to make on a monthly basis is very little. If the same corpus needs to be generated, so we keep the 4.97, almost 5 CRS constant, then the amount of monthly investment, Alex, now investor B, who starts at 35, goes up to 31,000, 3 times of what investor A needs to do. And the investment that investor C needs to make is actually 10 times of what investor A needs to do. So I think the ask is huge. You have other financial liabilities by then. So I think that's enough case that youngsters out there should go and start investing early on.
And I like the examples that you've given us, because 10,000 rupees per month is not a very large amount in the context of the paychecks that people get nowadays at the start. Even if they're saving 35%, sometimes even 40%, even with your first paycheck, you can start an SIP with 10,000 rupees. And 11%, again, like you mentioned, is a conservative estimate. If you look at the Nifty over the course of the last 10 years or 15 years, the CAGR would be more than that. But
Absolutely.
What if you're late to the party? And I think a lot of people tuning in who are slightly older, who may have had different priorities, Prableen, and it's not always fun and games. Maybe they had certain other responsibilities early in life. They were taking care of their siblings' education, all of those things. They're a little later, 40 or 50. Is it too late to start now, or what can one do to, make up that gap?
Absolutely, Alex. A lot of people are not in a very comfortable position to start investing right from day one. So there can be many people who are now in their 40s and 50s and, are looking to create a corpus for their retirement. I think first is a rough check of what, they need to do, as in where they are in terms of the milestone that has been achieved. So there is a nice chart given out by Fidelity, which actually suggests, a age-wise milestone, that how much should you be having actually by the age of 40, let's say, how much should you be having by the age of 50. So I think first thing is to check that. So as per that particular guidance, which is given by Fidelity, somebody who's 40 should be having at least 3 times of his annual income kept in the retirement corpus, set aside. So let's say somebody is earning 20 lakhs annually, should be having about 1.2 crores set aside. So this will give the person a rough estimate. If he, what is the shortfall, let's say, for him or her currently. And this guidance, I think, helps for those who haven't really gone into the math as yet. But a couple of things which they can do to now catch up on the investments for retirement. I think number one, Alex, is, of course, cutting back on certain amount of discretionary spending. Over a period of time, we get used to doing a lot of spendings which are not really in the essential basket. They are discretionary, and there is a scope to cut back. So, of course, you need to cut back and increase your investments. Second, I think a very important factor here is to review your portfolio. Are you stuck with, let's say, 3 properties and 2 EMIs, and the properties are not appreciating? Then probably it is time to rejig and sell off those properties and invest it elsewhere. Or is the entire corpus sitting in the EPF or PPF account? Then maybe some part of equities needs to be allocated. So I think a review of the portfolio is very important. What is the asset allocation mix at that stage? And what the investments, based on whatever investments have been done till then. Third, I think a very interesting way to help these people is, Alex, to look at step-up SIPs. So let's consider the case C of the example where what we had taken, that somebody who's starting off at 45 will only be able to manage about 47, 48 lakhs in 15 years with a 10,000 investment. But if the same person is investing 11,000 per month the next year, and then 12,000 the following year, and so on. So in the 15-year period, by the end of the 15 years, it would be about 25,000 a month. Because every year your salaries also increase. The same person can actually accumulate about 87 lakhs. So a small step-up SIP can again push up your retirement corpus.
Absolutely. In case you're late to the party when you're saving for your retirement, and I think you made a very pertinent point. You said that if you step up, you can make up some of that gap. But let's also talk about it in terms of a little bit more broad-based way. What are the key metrics that you can follow on an ongoing basis when you are planning that retirement corpus?
Okay, just two more things I'll add there first, Alex. That upskilling. I think because you said that what do people do if they're late for the party? I think as they plan their investments, they should also upskill themselves because it's very possible. It is very important to stay relevant in the workforce. And if they need to work for any, let's say 4 or 5 extra years, I think it would be very important that their skill set is totally updated. Uh, Now, broad-based products that we have and how we look at them here, Alex, that employee provident fund, public provident fund, mutual funds, and national pension scheme are the broader products that we have, which can be used for investment. And these different products have different sort of return projections. So a PPF would give us 7%, EPF would give 8%, 10%, and 11%. But just knowing what these products are going to give is not the complete picture. When one is planning for investments, it is for your retirement, it is very important to first know what are you looking to actually build. So a certain factor needs to go into that. One is till what age do you want to work and then retire? What are your current monthly expenses? What is the life expectancy that one is looking at? What is the inflation? Now, inflation is a very, very important key factor here because something that is costing 100 rupees today will be 10 times of the same price in 40 years. So let's say a 500 rupee thing today will actually be costing 5,000. So inflation is a very key factor here. And then the assumptions on what is your pre and post-retirement returns that we are expecting. So based on these, Alex, for example, let's take an example. If somebody has a monthly income of, let's say, 50,000, the same would actually inflate to be close to 3 lakhs in the next 30 years. So a corpus of 10 crores will be required if we are assuming a post-retirement return of about 5%, which I feel is realistic. But one really needs to be careful here with the assumptions because if somebody is assuming a post-retirement return of 8%, then the ask is only 7.5 crores for investment. So these numbers have to be managed the inputs have to be, picked very carefully, and the assumptions must be realistic to plan investments.
This is something, of course, that spans quite a few years, Prableen. And as a lot of financial planners like yourself as well, you point out that every goal should have an asset allocation strategy. So you have a certain amount allocated towards equity. In the context of what we're witnessing today as well, you have equity markets globally that are seeing a bit of a wobble. But you saw March 2020 where you saw a spurt that started that lasted quite a few months. At what point do you say that my retirement corpus, which is something that goes into perhaps 2 decades, requires to be tweaked? At what point do you say that you need to review it to adjust for the factors that are currently at play?
So I think, Alex, broadly, a portfolio should be, a mix of fixed income and equity-related products. And we don't have many choices, just the way I said, EPF, PPF should be used for your fixed income portfolio. And mutual funds and NPS, National Pension Scheme, should be used for the equity part of your portfolio. And as you build it, you create this asset allocation mix. Maybe in initial years, you have, let's say, 30% of fixed income and 60, 65, 70% of equities. And gradually, as you, with, let's say, every change in your life, let's say you have kids, you have more liabilities. So there has to be a review with your life stages and your lifestyles, because what you were earning, let's say at 35, you won't be earning the same at 55. So ideally, I think once in 2 to 3 years, one actually needs to review their retirement basket in terms of, where their salaries are now, what sort of liabilities they have. So reviewing your investment portfolio is one thing, but reviewing the whole mix and then checking, what do you have in terms of assets, consolidating the same, all that becomes very important as one gets closer to retirement. So reviewing your liabilities, reviewing your insurance needs, reviewing your consolidation part of your portfolio, I think becomes very crucial towards the final years of your retirement. The asset allocation would, of course, depend on individual to individual basis, what is the risk appetite and other specific factors for every individual.
Factor that is very dependent on the individual is the basket of expenses that you have. So
yes.
When you are planning how much you need post-retirement, should that come into play, or should you look at a standard number, say the CPI which is trending at around 6%? Should you take that into calculation when you're saying I need this much when I retire and this will inflate at this level over a period of time?
Yeah, Alex. So, of course, I think 6% is a reasonable estimation because we really don't know where the world will be 20, 25 years from now. So we all have to move on assumptions. And I think a 6% is what we've seen historically also in India. I think is it's a fair number to consider as far as inflation is concerned. But I think as we are seeing that, the ask for your retirement corpus is very high. Another factor which all individuals must consider is that they might be in a higher income slab even when they are earning from the retirement corpus. So the post-tax returns, Alex, here may actually work out to be lesser than inflation during their retirement years. That means that the estimation has to be done very, very carefully. And I think going with a 6% inflation number is fine because the WPI and CPI figures do keep going up and down depending on the supply and demand factors and inflation, how it is moving on an annual basis. So I think a 6% is fair enough.
I think you've given the example of 11% for equity products, which is actually, if you think about it, it's a conservative estimate. So if you go by 6% and 11% in your factoring of your calculation, I think you have the right idea. Prableen, I think we've covered quite a few bases, and I'm sure that my viewers will write into us on any one of our social media platforms or indeed on the WhatsApp number if they have specific questions, and we'll get you back to answer all of them. Thank you so much for joining us.
Thanks, Alex.